Welcome to the SeizeYourBusiness.com podcast and video blog. My name is Kevin O'Flaherty from O'Flaherty Law, joined as always by my co-host Brian McDonald from On Purpose Growth, and our guest today is Paul Keough from Keough Investments. He's appeared on CNBC before, so I'm pretty excited to have him with us. I didn't find that out until I met with him several times, but we're going to talk about today. Our topic is going to be the information war and emotional finance. I'm excited to dig into that. Thanks for joining us.
Thanks for joining us, Paul.
Yeah, happy to. I've watched several of your podcasts, and what a blessing for your community here.
Oh, thanks.
Because a lot of entrepreneurs, information war. Where are they going to get good information? How do they know about other vendors? How do they know who to turn to for good information? And you're doing this in this podcast. As you've admitted yourself, you're educating yourself in some of these sessions, getting some free consulting, but so are your listeners and people watching these podcasts. So it really has done a great thing.
Well,
and I keep hearing about it from vendors I work with, what it's done for this community. So.
Well, good. That's great. We could talk about that for another time.
Sure, why not?
So Paul, tell us a little bit about your background and what you do.
Sure. So I grew up the ninth of 13 kids, poor, didn't have shoes, didn't have pants. I mean, basically everything was hand-me-downs, and somehow I became a Wall Street analyst. If you can answer that, tell me. I don't know how it happened myself. It's a random series of events. I got a lot of graduate degrees, got a doctorate, got an MBA, became a Wall Street analyst. And the reason I did it ultimately was that I felt it was a platform from which I could have influence. And I thought, if I think a company should raise money for research, because I covered biotech and healthcare and pharma, I can tell them they should, because it's a buy rating and money should go here. If I think a company's wasting its money on technology that's not going to work, I can rate it a sell and tell people not to put their money there. So I thought it was a great platform of influence. However, I discovered that I couldn't do what I wanted when I got on Wall Street. What I wanted to do was help the average Jane and Joe on Main Street invest. What I discovered is it wasn't built that way. And what I was really doing was helping billionaires get richer.
Wow.
And it's not what I wanted to do. So I was sort of a reluctant Wall Street analyst the entire time I was there. I made an agreement with my wife to leave at a certain point, and Lisa was a Wall Street analyst. I don't know if I've told you that.
Yeah, you did.
Oh, wow. Okay.
And so when Colin was born, our firstborn son, she left. By the time our fourth-born child, I left. And I kept my promise. It was very hard to leave. But one of the main themes that I saw on Wall Street was information, and this information war. And I believe we're in an information war with countries that are not friendly, with countries that are friendly, with ourselves, with each other.
Yeah, right.
Good information is often the key. And with the advent of the internet and the World Wide Web, anybody can go on the web and Google things. But how do they know what they're Googling is a reliable source? It can be garbage. You can go on blogs and you can get bad information, disinformation, misinformation. How do you know it's good? So that's where we have experts. You're an expert in law and marketing, and I'm an expert in finance and investments. Okay, so we go to experts. We try to find those we can trust, who we feel will have the right ability to distinguish between good and bad information. Okay.
Can I give you an anecdote of how this affects? So,
sure.
like, the past couple of days, tax reform has gone through, and everybody, I swing trade a little bit with my, with my IRA, and probably a terrible idea, but I enjoy it. It's my hobby.
You're allowed.
Yeah. But, everyone's like, oh, well, the stocks are going to go up when tax reform comes. So I see that Facebook and Netflix and Google, all the FANG stocks, the stocks that have been crushing it all year that everybody wants to be in, are like, they're down 2%. I'm like, oh, great buying opportunity. Tax reform's coming like tomorrow. I'm going to get in on these. And I read all about them. I read, Seeking Alpha. I read, what I could. And I didn't find out until after I bought them. And then they kept going down and kept going down for the next couple of days that, the tax bill doesn't actually benefit technology stocks. Well, and I thought I had the information, but other people did, and I didn't.
Well, there's another level to it, if I can espouse and give an opinion.
Yeah,
my opinion is what we believe at Keough Wealth Management is that that tax bill is already priced into the market. In other words, the assumption on Trump's election was that he would reform tax and drop corporate taxes from 39 to 20%. And we saw the market go up. Okay, so it's already been priced in. The tax bill passing, which it hasn't yet, right? You've got a House bill and a Senate bill now. They need to reconcile. Okay, Then it has to get to the president, and he's got to not veto it if for some reason he decides it. So we're not there yet, but we're closer. Once you have both houses and the Senate decide having a bill, then it's just reconciliation, and we're closer, okay? But so if it happens, that's as expected. The problem is if it doesn't happen, okay? I see a downward correction.
Sure.
Okay, I anticipate a downward correction, and I wrote that in my newsletter 3 months ago. I've been writing about that. That the problem is if it doesn't go through, and we're assuming that corporations are going to get this huge break on taxes so they can hire, so that they can reinvest in research and development, and it doesn't happen, that the market is then overvalued. So it's really the other side of the coin that I'm worried about. And how would you even know that? How would you know it's priced in?
Right,
You'd have to have a fundamental analyst who looks at numbers and looks at what economists are saying. And the big firms that I trust, that I think do a better job than some others, like PIMCO, because I think their chief investment officer is very smart. And knowing that information gives me a good ability to then forecast what I think will happen based on a binary event. The binary event is it passes or it doesn't. Okay?
Mm-hmm.
Either this bill becomes law or it does not become law. Okay, so there's an example, where the information that's out there can tell you all kinds of things. Anything you want to hear, you can hear. And I equate this often to, let's suppose you needed surgery.
Mm-hmm.
Okay, you need surgery. Who are you going to go to get that surgery done? Rush, who's done 10,000 knee surgeries, and everyone has come out beautiful afterward because he's the world expert there in knee surgeries, which I think is actually true of Rush, okay? Or someone who says, well, I just got out of medical school and you'll be my first patient. Or someone who's not a doctor. I mean, who are you going to choose? So just like any field where we recognize expertise, and medicine is one area where we recognize expertise, looking at finances and forecasting is a field of expertise, whether people know that or not. Okay, law is a field of expertise. Whether people recognize it or not is something else. Okay, so of course we're going to pick the doctor who's done it 10,000 times. So I've worked with thousands of people, and I was a Wall Street analyst for a decade, and I've worked with individuals for 12 years. I got 22 years of experience. And I had the good fortune to be at top firms like Wells Fargo, where I got to be on investment policy committee and get to know all these amazing people at other firms and the top thinkers and bring that to Main Street. So really my goal was to bring that boutique expertise of the big investment banks to Main Street and help people. And I've been able to do that, so it's been wonderful. Now, the other question I often ask myself is, can I bring people in Main Street the same information that hedge funds and mutual funds have? I cannot.
Okay. Yeah, can I ask? And some of these questions are going to be like my dog asking me about law, because you've got doctorates from Northwestern, and I swing trade a little bit as a hobby. So excuse that, but
okay.
There's the efficient market theory, I think it's called, where everyone thinks that. And there's different levels of it. Some people say all knowable information is priced into the market. Some people think that like you said, the tax bill is already priced into the market. Do you believe that, and people who believe that are really proponents of technical analysis, right? So they're just watching the price charts and not really listening to the news. What do you think of that theory that the information's already, in general, is already baked in, everything that
It's not baked in. Not everything, no. If it were, then thered be no need for my profession.
Oh, right.
Okay, so there's strong form, which is what you're referring to. There's semi-strong, there's weak form. Depending on the day, we're weak form or semi-strong form. Okay? Depending on who you're talking to and what they know more, they know less, like anything else.
Mm-hmm. So if you have all the information, you can actually make better decisions.
Well, you'd be God if you had all the information.
Sure. But I suppose if you're closer to having all the information on the spectrum than just looking at the price chart, it's good to arm yourself with that.
The better your information at any point in your life, regardless of the field or what you're doing, you have a better chance of making a good decision. No guarantees. Insurance companies will give you guarantees that are false. What they're really doing is they're pricing in a lot of extra costs, like annuities. Someone you spoke to about annuities. They didn't tell you about costs. Okay?
Yeah, right.
So insurance companies price in these so-called guarantees by increasing the costs. When I say there's no guarantees, you pay for what you get, right? So you're paying for these so-called guarantees.
Sure.
So there are no guarantees. We're not God, so we don't know everything. But certainly we can know less or more. Mm-hmm. And the better information you have in any field at a given point in time when you're ready to make your decision, the better the probability is you'll make the right decision. No guarantees, but certainly it helps, right? So when I say that, you and I don't have the information at a hedge fund or a mutual fund, I mean it. They have a lot of soft dollars to spend on consultants who can get information that's non-public. Okay?
And so it's not that they're not better
cheating.
read. They're not sitting there all day looking at more internet articles than I am. They're actually paying somebody to do analysis that's not going to be available to me, the average.
Yeah, they can be. There are legitimate people on the buy side who do the very things you just mentioned. They look at the internet and they look at the sources available and make good decisions. Those people exist. But also they have soft dollars to spend in areas where the average person does not. So how can you compete with them? There are certain areas where you cannot. So for example, let's say there's a hedge fund who knows a clinical trial is going to fail. They know because of information they have that you do not. Mm-hmm. They know the stock is about to be axed. It's going to be cut to 1/5 its value. Or they know the trial is going to succeed and they know the stock's about to go up 5-fold. Okay? You don't know that, they do. So what does that tell you? You shouldn't be involved in binary events if someone has the knowledge and you don't. Think of what Warren Buffett said. Every time he buys, he's afraid there's someone selling who has a better reason than he does.
Yeah, right.
Every time he sells, he's afraid there's someone out there buying who has a better reason than he does. That could be true. We just have to have that natural fear in us that we could be making the wrong choice.
In a binary event, 1 and 0, right? It's like either the thing fails or it doesn't, right. And you may not have knowledge that someone else has, as opposed to, analyzing the profit and loss statement of the company and just making good fundamental business decisions, right?
Both fundamental analysts do both. So I look at their statements and read their filings and all the public information, but you also look at statistics and you try to look at those binary events and decide. For example, will we have a law or not in tax reform? Will the cut tax reform go through or not? There are people who are political analysts. They'll look at the politics and try to give the probability that the bill will become a law. I'm not a political analyst. So what I'm trying to say there is we have to know our limits, okay? If we can't know something, should we invest in one side of that decision? No. If you have no idea, it's the same thing as flipping the coin.
Then you're gambling at that point.
Right.
Then you're purely gambling. Right. So one of my messages to the people on Main Street is don't get involved in things you don't know. I mean, it sounds obvious, but I see it all the time. So what is the result of that? So there are certain things that are knowable to people on Main Street, especially if they have an expert like me doing the research in the public arena. So work in the knowable area. Just increase your probability of making the right decision, and don't get involved in binary events that you have no control over.
That's what. Go ahead, Ben.
No, so how did before we started, you were describing a dilemma on Wall Street in regards to stocks or companies being rated buy or sell. How does that dilemma play into what you're describing?
That's a good point. Misinformation. It plays into misinformation. So if you've ever wondered why more than 80% of stocks are a buy rating, okay, one of the reasons is that research analysts are hired by investment banks for the most part. There are individual research boutiques where they're not hired by investment banks, but the vast majority are hired by investment banks. Well, the number one way that investment banks make money legitimately is investment banking. Mm-hmm. Secondary offerings, IPOs, it's what they do for a living. There's nothing wrong with that. But for the analyst working at an investment bank to rate a stock a sell potentially could hurt the bank if the bank was planning to do banking activity with that company. Okay, so why are more than 80% of stocks rated to buy? Well, okay, so there's some misinformation. All right, so that's an example of misinformation. Okay, and there are many examples out there. I mean, we can go into many such examples, or we could do it a separate time. But basically, I think the most important thing that we can know about ourselves as human beings is what we don't know. I don't know law. I don't know accounting. That's why I refer my clients to lawyers, to accountants. I don't know real estate. That's why I refer my clients to real estate experts. Now, I do planning, and I do planning in all those areas I just mentioned and 17 more. I do what I call comprehensive life planning, and I do 20 areas. That doesn't mean I'm an expert in those 20 areas. I just do the planning and the forecasting, okay? But if I could segue, about a third of those 20 items that I do in what I call comprehensive life planning have nothing to do with money or numbers. Now, when people come to me, the first thing they'll do is show me their numbers, and I'm used to that. They'll show me their numbers and assume I'm an accountant. I'm a bean counter, okay? But I'm a finance person, which isn't the same thing for people who know finance. I forecast. I look ahead and try to plan and strategize. What does it mean? What do the numbers mean? That's really what finance is, okay? By the time people will tell me about their money, they will tell me anything about them. I don't want to know those anythings, but they've told me. Okay? But what I started thinking is, well, if I'm a fiduciary, do I have a responsibility to do something with this information they're telling me? So I started doing research, and I came across a field called emotional finance. And it was laughed at 20 years ago. And 10 years ago, people started realizing, hey, this makes a lot of sense with game theory, maybe even 15 years ago. And now the most recent Nobel Prize went to the person who founded emotional finance. The reason this field is important is that when I went to business school and had economics class and corporate finance, one of the first assumptions you're told is assume a rational market. People behave in a rational manner. You're laughing. Does anybody believe that?
Right.
People do not act in a rational behavior.
That's how Warren Buffett made all his money.
Yeah,
when people are
the
acting
difference,
irrationally.
right? Semi-strong or weak form is that there's a difference between what should happen and what does happen.
Yeah.
And that difference we call an inefficiency, and you can take advantage of that inefficiency if you understand it. But we're human beings. We have emotions, okay? We do things for love. We do things with our heart, okay? So what can you do with this sort of qualitative information? Okay, what can I do with people telling me what they think of money, what money means to them, the purpose of their life, their faith? What are you supposed to do with those things? And this field of emotional finance is a way to take this qualitative information and turn it into quantitative numbers. And so I do that for people. And I think many of my clients are startled, one, by the depth and detail of what I provide them they've never seen before. I get that all the time. Okay?
So how do you quantify something qualitative?
Well, you can figure out what sort of categories it fits into, kind of like the field of psychology.
Okay.
I mean, emotional finance is where psychology meets finance.
Right.
There's all these integrated fields. I went to Northwestern's Integrated Biological Science program. There's only 4 in the country. And our goal was to integrate biology with other fields. Okay, so right away I recognized that psychology and finance, there's probably some overlap, and we call that emotional finance. When you are asked on a pain scale of 1 to 10, are you a frowny face, a neutral face, a smiley face, and the kid points, that's a scale where you're taking something that's not a number, how much this pain hurts, and you're turning it into a number.
Yeah.
Okay, so that's emotional finance. And I've found it's very powerful because, well, let me give you an example. Okay, this has happened to me several times. I'm on TV and then people call me. Okay, and they're not always people that you want to talk to, because sometimes, I mean, most of the people are wonderful. 99% are wonderful, but once in a while, you'll get a stray cat. And someone calls and says, "Make me rich." I'm like, "I'm sorry, what?"
They literally ask you that?
Yeah, make me rich. I'm sorry. What do you mean, make me rich? Just tell me what stock to invest in. Okay. Now, the main reason I don't want to answer that is I could get in trouble, number one.
Right,
okay?
yeah.
Because I don't know the person's suitability, risk tolerance, okay, and a variety of other things. Let me give an example. Suppose I do believe there's a hot stock that I think people should invest in. It's not everybody I think should invest in that stock. You have to be able to tolerate the ups and downs of this particular industry, like biotech, where the beta is a 1.6. You know what I mean?
Yeah.
No, it's the most risky industry. I'm teasing a little. But, so very, very risky. So the stock goes like this. Some people cannot tolerate that.
Right.
Okay. Well, if you can't tolerate it and the stock goes down, you're going to sell at a loss. But suppose 2 months later, it jumped tenfold above where you bought in the first place. You missed the opportunity because you couldn't tolerate it. Okay. So it's not for you. It's the wrong investment decision for you because you're going to lose money. Okay. So that's where emotional finance comes in.
So every wealth manager in determining suitability is going to say, how old are you? You're looking to grow, or you're looking for security, and you're adding a whole bunch of other elements,
more, yeah.
other wishes and desires that you have in determining what suitability is.
What does it mean? A recent study shows by Cirilli, which is a big research group in my field and for financial advisors, that shows that more than half of success with your investments has nothing to do with your stock selections, or ETFs or mutual funds, or whatever you choose, bonds. Okay, your vehicles. It has nothing to do with that. It has to do with whether the strategy fit you or not. Okay? There are over 200 strategies that I've implemented with people. Okay, and I've worked with thousands of people. It's not about the strategy. It's whether or not it fits you. If that strategy does not fit you, you're not going to stick with it long term, and it will fail. I don't care what the strategy is. Okay. So one thing I tell my clients is one of my first goals to get you into your financial shoes, to get you comfortable in the financial shoes that will fit you like a glove. Okay. And once you do that, the results show it. So my average client that works with me, I'll say to them, would you like to do a quarterly review? Okay, I'm supposed to do quarterly reviews. Okay, it's supposed to happen. Every magazine I read, every article I read tells me I'm supposed to do quarterly reviews. They don't want to do quarterly reviews with me. And I think, uh-oh, I'm not doing my job, and they're going to go to someone else. And I'll say, would you like to do a quarterly review? No, I'm perfectly happy with what we've done. Well, but according to what I've been told, I'm supposed to do this quarterly review thing. Right. So, but they're perfectly happy. Well, if they're perfectly happy, there's no need for a quarterly review. Okay. So while it's boring for me, it's good for the client. And ultimately, my goal is to serve the client.
Yeah.
And if I'm doing the right thing for the client and the client's happy, that is the result that's supposed to happen in the first place. So this field of emotional finance, my peers out there, you really should look into it. People who are looking at financial advisors and trying to find the right fit, find someone, if not me, someone else. If you're far away from me, find somebody who is paying attention to this field. My field is changing at an incredible pace. It's changing so fast that if you don't keep up on what's going on, in 2 years, you're a dinosaur.
Wow.
Okay, I really believe that's true right now. For example, there are robot advisors. Have you heard of this? Robo-advisors.
I've heard of that. I don't know what the heck it is, though.
Okay. Are you guys fans of chess? Did you guys play chess in school or anything? So I run a chess club at my kids' school. And I often talk about chess and how Bobby Fischer used to be able to beat Deep Blue, which is a Cray computer. And then it beat Bobby Fischer, and then it beat Karpov and Kasparov, and now there's no human that can beat a computer. So some people are thinking, well, can we do that with finance or law or any of our fields? Are we all in danger of computers being better at us than this? Well, I can say, knock on wood, that it's not true in finance.
Yeah.
It hasn't happened yet. Could it in the future? I can't rule out the possibility that it could happen in the future. But right now, there are so many variables and human factors to investing that right now the robo-investors, it's a beginning, it started, but it's an infant right now, okay? But if you don't pay attention to it, I think that's a mistake as a financial advisor. And emotional finance is something that if my peer financial advisors are not doing, reach out to me. I'm happy to help my peers as well. I do education for my peers. But it's very important because it's making such a dramatic difference for clients. And are there aspects of robo-advisors that should be incorporated? I think it's getting to that point. There are certain parts of tests and surveys where I can just have them go online and fill out a survey. Well, that's a robo-advisor to a sense, right? I mean, they fill out the survey and I look at the result. And psychological profiling, in terms of hiring people, some firms will do tests online to determine
like personality
profiling, these sorts of things. That's a form of robo-advising at a basement level. So, those tools exist, and financial advisors should be accessing them for the good of their clients. Okay.
Well, Paul, thanks so much for sharing your wisdom with us today. I'm going to have you on the podcast.
This is great.
We'll have all of your contact information on our website, so if you want to call Paul and ask him to make you rich, you'll be able to find his contact info.
Realize it's a process.
So thank you so much.
Thank you, Paul.
I appreciate it. Thanks so much.